In a financial context, liabilities typically represent debts or obligations owed to creditors or other parties. These obligations can arise from borrowing money, purchasing goods or services on credit, or legal responsibilities incurred through various transactions or agreements. Examples of liabilities include loans, accounts payable, bonds payable, accrued expenses, and taxes payable. Here's some key points regarding the treatment of liabilities under each framework. Conceptual from you. Both GAAP and IFRS follow similar conceptual frameworks in defining liabilities and determining their recognition, measurement, and presentation. Recognition. Both frameworks generally require the recognition of a liability when there is a present obligation arising from past events, and it is probable that an outflow of economic benefits will be required to settle the obligation. This is often referred to as the probable outflow of resources criterion. Measurement. GAAP and IFRS allow for different measurement bases. For liabilities, such as historical cost, current value, or amortized cost. Under IFRS, fair value measurement is more commonly used compared to GAAP, which tends to rely more on historical cost. Both frameworks provide guidance on how to measure various types of liabilities, such as loans, bonds, and contingent liabilities. Presentation equity for liabilities are generally similar under both GAAP and IFRS. They are typically presented on the balance sheet separately from assets and equity. Current and non-current classification of liabilities, i.e., distinguishing between liabilities due within 1 year and those due after 1 year, is required under both frameworks. Leases. Both GAAP and IFRS have standards addressing lease accounting ASC 842 under GAAP and IFRS 16 under IFRS. While the overall principles are similar, there are differences in certain aspects, such as the treatment of operating leases, which were traditionally off balance sheet under GAAP, but are now brought onto the balance sheet under both frameworks. Contingent liability. Both GAAP and IFRS provide guidance on the recognition and measurement of contingent liabilities. However, there may be some differences in specific requirements and thresholds for recognition.